And thanks for a very good introduction. You mentioned believing yourself, and I believe it's a key word. Don't believe us. We might tell, do this, do that, and so on. But that is not a very certain way how you should build a business. About believing yourself, I have noticed later on an interesting thing in my career. I went to university, I worked in financial sector, helped to establish the Estonian Stock Exchange. The first job I had was about trading, issuing bonds and so on. And I had no idea how it works. So I went to a job interview and I basically lied. I said I know everything about it. And for some reason they hired me. And of course, then I need to prove that I know it. I worked in Ministry of Finance as Deputy Secretary General, which means I was responsible in Estonia for state budget, tax policy and economic policy just before we joined the European Union. And at that time I tried to figure out what I'd like to do in life. And I thought probably it's a good idea to be a CEO in one of the large corporates in Estonia. And I particularly liked Estonian Energy, that is an energy provider. You probably imagine you have here electricity as well. So, and I wanted to be CEO in one of the companies in Estonian Energy. And when I was in Ministry of Finance, I thought, I know financials and I have worked on financials and trading and budgets and so on. But to be a CEO, you should understand human beings as well. And I thought it would be good to be CEO in one of the Baltics' leading HR company called Fontes. I just thought about it. It makes sense. But I don't know anything about HR, definitely. And one day, just the owner of Fontes called me, asked, would you like to join Fontes, the HR company, as CEO? I didn't know him. He didn't know me much, but made me offer. Exactly for the job I had in mind. So I, of course, took the job, and this was probably one of the best experiences I have ever had to understand human beings and to understand HR, which is very critical. And then 1 year passed, and then CEO of Estonian Energy called me. The company I thought about, I would like to work. And I completely don't understand anything about electricity, and I still don't understand it. But he offered me a CEO job in the subsidiary of Estonian Energy, which is responsible for all the electricity cables all over the country. The worst job one can imagine, because you are always guilty for every single electricity interruption in Estonia. So that is never good news, there are only bad news. But it is a very, very, very useful experience. And as I mentioned yesterday as well, you probably asked about, what about your first money and so on. The first part of my life I have identified as a time to get experience. And you have also several ways how you could look at your startups or your companies you're building. Definitely starting a company immediately makes sense and gives experience. The alternative is to go and work, to learn and to get experience in other companies in the areas where you would like to set up the company. To take more time, but to prepare yourself better. So, but none of them is like the only truth. You can figure it out. And actually in Estonian Energy, I worked for 4 years, and I thought, it's the same strategy process and electricity and stuff, and I enjoy a bit more to be a board member to help out a number of companies. And I felt I was losing my English language already because it was a very local job and so on. I thought it would be a cool idea to manage a portfolio of companies. And there is one company in Estonia which is called Ambient Sound Investments, that is actually Skype co-founders' family office. Skype was founded by one Swedish guy, one Danish guy, and by 4 Estonians who are listed up here. And when they sold Skype to eBay, they kept part of their money together in the company called Ambient Sound Investments and started doing venture capital investments. And around 2008, they called me, asked if I'd like to start managing their venture portfolio, which is exactly the type of job I actually had in mind. So things happen if you really think what you want. The problem of most people is they don't know what they want, or they are not bold enough to decide what they want. It is a hard decision to decide, I want this. And I don't know if it makes sense to think about, I want 10 million euros or so, but I have always defined the experience I want, and it has always happened, even namely by companies without doing anything to get that particular job. So right now I'm working at Ambient Sound Investments. We have had about 25 portfolio companies around the world. That is very light blue. If you happen to see, it should be a world map, but you figure it out by names anyway. We have had a number of companies in Europe, maybe 10 or 12, a bit more, 3 in US, and 4 in Asia. And all of the startups, I would say, are completely different stories. There have been rookies who don't understand much, but have built great businesses. There have been very experienced entrepreneurs, but failed. We have had to written off like maybe 5 or 6 companies actually. So there is not a certain way how to produce companies. We can tell that you need to figure out what is your customer problem, right? Work on it, ask people if they want it. But what kind of customer problem Angry Birds solves? Can you go to the street and ask, would you like, to have a game where there are like birds and beaks, and then beaks take away eggs, and then birds crash the beaks? It's not possible to ask actually. Or I'm still struggling, for example, how you would define what kind of problem Instagram solves. Can you go to the street and ask, do you have a problem with sharing pictures? So there is definitely a mainstream way, which means it is good to solve a big problem. Exactly what we have told here. But there are also visionary people who understands what you need, but you don't understand it yet. So someone quoted Henry Ford lately. He said, if I would ask from customers what they want faster horses. But he figured out that it will be cars. So, and definitely Steve Jobs has been very visionary guy who don't ask from customers what they want. He believes he knows how the future will look like, and he shaped very much the future. So to summarize that small comment, definitely listen whatever advice people would like to give you. And the best entrepreneurs in our portfolio, they have this very unique ability to listen and to discuss. Very often we have discussions with founders and entrepreneurs. You ask, you get the answers, but there is no discussion how it should be. And discussion might always lead to new opportunities. The most successful entrepreneurs, they decide themselves what is right, but they are always willing to listen and consider. So believing in yourself is a good stuff. Particularly You might think investors are smart, but they are not. There is one very famous US venture capital company called Bessemer. Have you ever heard of Bessemer? It has done a lot of good investments. It is famous of building great startups, but they have always been honest about their anti-portfolio. The companies they thought doesn't make sense. And for example, in their anti-portfolio, there is Apple. At the time Apple started and was about to make IPO, it was offered to Bessemer as well. But Bessemer's partners thought Apple cost $60 million at that point of time, and they said it's outrageously expensive. Never ever we are going to invest in that kind of company. So eBay, stamps, coins. What stuff is that? Definitely we will pass it. Never gonna make it. Federal Express 7 times said no, but the company made it successful. We have in our portfolio, we have companies where we have said like 5 times no, we don't invest. But they became successful later. The probably most famous story is about Google. When Sergey and Larry tried to code the search engine somewhere in the garage, then one of the venture partners from Bessemer visited the landlord of that garage. And the landlord said, I have 2 guys, figuring out the new search engine in my garage. And he thought, students, not again, search engine. There are plenty of them. How can I get out of this house without seeing that garage? And it was probably the biggest mistakes ever he made. So, and it's actually a good example how venture capitalists think. Search engine, again. And maybe you have heard as well, and you definitely will hear, that you come up with your business idea and investors or whoever. I have heard about this idea. This idea is already implemented here, there, or whatsoever. It really doesn't matter. There were a number of search engines before Google started. There was a number of VoIP calling solutions before Skype started. There was no obvious reason why Skype was successful. There were a number of solutions available before. PayPal. They thought it's inexperienced team. It is very regulatory business. It's complicated to scale over countries. Never going to make it. And after 4 years, it was 1.5 billion. So again, it's better to trust yourself. This is the best advice one can really give you. But still, financials and investors, there's one very famous accelerator in US, maybe you have heard about it, Y Combinator. Most of the accelerators really don't work, and incubators. They are not able to produce successful companies. But Y Combinator has been quite an exception. The owner of it, Paul Graham, don't allow too many mentors and advisors to look at his portfolio companies. He's advising quite a lot himself and building the ideas around how he thinks the business should be done. And he has said that probably the skill how to deal with investors is the second most important thing they teach in Y Combinator. Because investors might add value, but they might also kill the company if you don't know how to handle investors. What might be the first most important thing? At least Paul Graham thinks. What is most important thing? True? Profit. Okay. What else? Price? Trust. Okay. Confidence. Truth. Okay. How you would teach them trust, confidence? Sorry?
Creativity.
Yeah. It is actually product. Really, your product. What it is, what you build, how you build it, what value it adds. Product first, investors second. Yesterday one of you asked what the investors look for, and this is really important to understand, because if there is no understanding in place, startups can make a lot of mistakes. And actually, honestly, venture capital investors need to get 10 times money back. And it's not about actually, it's not about greed, or it's not about, that venture capitalists would like to become tremendously rich. It is the way how venture capital works. To make things simple, you invest in 10 companies, 5 or 6 of them you write off 0. And then 1 or 2 companies must make 10 times money back to cover all the losses you made from other portfolio companies, and then also a little bit return. So it is good to understand how venture capital actually works. Scalable business models. I have a very kind of simple example on that, what it means. But basically it means that your revenues should go very clearly faster than your cost base. Some of the models, business models, are not scalable. For example, book publishing on paper, if you always have production cost, and you cannot add substantial price on top of it. There is always sales price and cost of a book. Team. And team is one thing where for example, venture investors, you will probably might meet, investors like tens or hundreds or so, and they will say, we will not invest because your product is in too early phase, or because the addressable market size is too small. But in reality, what they never say, 90% of reasons why they say no is that they believe that the team might not work out. So, and this refers a bit to the fact that maybe to increase probabilities, it might be good to gain some experience before. For example, in coffee business, you understand how to roast coffee and you can really explain in details. Or in book publishing, you know how to protect ebooks from piracy, for example. You are confident in topics that investors might come up, because team is probably number one reason why projects are turned down. And one item I mentioned yesterday as well, addressable market size. This is actually a killer as well, if not to think about it early enough. Well, first, there are 2 types of companies. One is lifestyle. You understand it well. You do a business, it creates nice profit, but it's not scalable, it doesn't expand, the numbers are not huge, and this is perfectly okay. There is nothing wrong with that. If it's right for you, just do it. But on scalable areas, the addressable market size becomes a key factor, what it is. So what is the total market size you can address with your product? For example, babysitting solution. How many babysitting hours are bought in this market per year? About ebooks, how many of them are bought? How large is the potential market? What else we have? Gifts. How many gifts actually can be sold? Yes, you can sell so many coffees. That is true. And now, what is a large enough addressable market size? First of all, this is a question that is always asked, and it is very professional to be prepared. We have tried to raise capital for some of our portfolio companies. And if they have addressable market size $1 billion, it's too small. Too small. And again, it comes actually down to calculations about, is it possible to make 10 times money back? So how big the company should be that it really at the end of the life cycle, at the time of exit, when you sell the company, the strategic or whatsoever, can produce investors money back. And usually you need to have like 500 million euros revenue, maybe 300 million euros revenue, and then 1 billion. If the total market is 1 billion, you need to grab 30%, 40% of the total market. And this is complicated. So just to bring a very small scale example, if anyone would do a very small investment, like 100,000 euros, it's a seed investor. Yeah, later on, probably let's try to figure out what is the potential cost of your business as well. You give 20% of your company away to the new investor. You sell the company in 5 years, and you need to sell it at least for 5 million euros minimum. So with 100,000 euros, you need to create at least 5 million euro value. But in practice, there will be follow-on rounds, and probably the value has to be substantially higher.
Sorry.
Yeah.
Sorry. Is this value your share?
5 million euros total company share.
Total company. So
Yeah.
your would be half million, right?
1 million. 1 million.
Yeah.
Yeah. So it's definitely possible, but it's good to keep in mind what kind of ambition you must show. And secondly, very trivial example of scalable business. It just basically shows revenue growing fast, cost staying the same, profit increasing, and one of the examples we take later as well, the profit margins. Investors look profit margins, which is what is the profit out of revenue, very closely. Over here we have a kind of theoretical, but what type of businesses can grow in a way that revenue grows substantially, the cost stays the same? What type of IT? Yeah. Social media. Yes, it might. You create a platform. I don't know, social network. You have the platform running. The product is good. People come on board without substantial advertising, and you sell advertising on top of it. Might be. The idea like you have.
Maybe satisfying the users are advertising your product by themselves, and you haven't paid anything for additional promotion.
Yes, this is the best way to scale the business. It's called viral factor or something like that. When your users spread the word in a way that you don't need to do basically anything. Again, Dropbox has used it rather successfully as well. I believe they gave a few gigabytes away if you send the notice about Dropbox to 5 of your friends. And very easy way to attract additional users. So what type of businesses can we bring out more? Gaming.
It has same cost every year, yeah?
Sorry?
It has same cost every year.
Yes, pretty much. Of course, in reality it fluctuates and it probably will go up and so on. But gaming, you do a game. You have made all the investment.
It's not a product for producing something. It's permanent cost. Maybe they make something and after it has no need more costs.
Yeah.
Same cost every year, like
Yeah.
rent or something else.
Yeah. So for example, ebook publishing might be the model. Where you translate ebook, you don't have paper cost because it's digital, and you can sell it forever, literally. So every year you translate like, I don't know, 10 books, but all of them are selling, and you don't have, if you sell one item, you don't have any monetary cost basically.
Maybe it's like
Sorry?
internet something, connection or
Connections are usually hardware related. Everything that is hardware related is has production cost in it. For example, Lightbox, the project you have, every setup is a hardware cost related. But when you have done all the investment, then investment cost will go down, and if you have a very good way or partnership to get advertising on board, then it might be reasonably scalable. But the initial hardware cost is definitely substantial if there is no sponsorship in place. Software licensing, for example. You build software, and over a period of time you can, of course you need to do product development, but again, you don't have production cost as such per product in a way. So I almost titled the presentation Financials are boring, because I really, about the financials, this is the least I enjoy in startups. But who really needs financial plans?
investors.
Investors. Okay. Anyone else?
Everybody.
Who is everybody?
You need financial plan for your own as well.
Yeah. Shareholders, partners, employees. But most of all, it is absolutely critical to yourself. And there are basically mostly three ways how it's used. Of course, investors. When you fundraise, you want to have additional money, you need to have very clear financial plans in place. It's a communication tool as well to employees, to partners, to show what kind of business you're developing. What is the potential upside? What is the potential upside for them if, for example, Samsung will give TV sets to Lightbox? You know, what kind of business Samsung can make out of it if you give a little bit revenue share to Samsung as well for TVs. So employees, is it an attractive place to work? What are potential risks ahead? Can it be that we go like to zero and revenue will not come up? So, and in terms of management, this is the most important tool for you. Even though some investors say it doesn't matter what your financials are. There are two types of investors. And personally, I consider it still important because from your financial projections, I can see what is your long-term goal, what is the ambition. And we have seen plans where, you know, the revenue comes from 100,000 to 500,000 in 5 years, which means there is no ambition really in place. This is not right investment for venture capital. You can see from 0 to 500 million in 3 years. Well, you can see that maybe it's probably not realistic. It might be, but it's really hard to predict if it's true or not. So it shows basically the financial plans tells quite a lot about you and about your ambitions. How you make it? Have your assumptions realistic ones? Employees, how many employees? Cost of the product, how it grows exactly. Sales, marketing, how much you have budgeted. And in some areas, there are very clear rules in place. In games, how much usually goes to advertising, for example. In marketplaces like Booking.com, for example, or OpenTable, there are very certain ratios in place, and the investors can check if you understand the market or not. But some of the investors, particularly from US, are telling, it doesn't matter, your projections are wrong anyway. That's why it doesn't make sense to do them. And some of the investors emphasize just have customers. That's it. For example, in gifting business, try to get as many customers on board. Let's figure out later how exactly we make money. Or in babysitting solution, the same way. Try to get as big community of parents behind you, and let's figure out what the exact business model is later on. And I'm not sure, for example, Instagram was sold for 1 billion, but I'm not sure if they have figured out their business model yet. No one is paying to Instagram anything, right? So the key questions in financials, in broader picture. The first thing is how much money is needed to break even. Do you know the break-even point?
Yeah.
So basically, when your revenue is large enough to cover all your costs. And this is a point where all the entrepreneurs should, as aggressively as possible, to aim. It relates to a third point, how capital intensive it is. And a few of your businesses, for example, the plastic bottle recycling, it might be extremely capital intensive. And very many investors cannot take capital intensive projects on board. If you take, for example, you build a kind of renewable electricity, I don't know, water-based or wind-based wind farm, it takes maybe 20 million euros. And you start with the first ones, but at that point of time you already need to take investor on board who has money to finance it all if needed. Taking money from small investor who don't have much money for a big project is potentially a substantial headache. For example, we as Ambient Sound Investments, we have about 100 million euros under management, but we are not able to invest in renewable energy projects. Lately we looked at one of the wave energy projects. Prototype only costs 5 million euros. And later on we are just not able to finance it. When the break-even should happen, then what type of financing you should consider? And definitely makes sense to build scenarios. What if it goes this? What if it goes a bit more modestly, to understand how much capital it might take? Very quickly, some types of financing. Usually in early stage, investors would like to take part of your company. No one is willing to give you a loan. You have no collateral. You have no revenue. So the best thing is to become part of your company and to own part of your product, your team, everything you have basically. When you grow, of course it's possible to take a loan. There is an instrument called venture debt or venture loan, which you might get in pre-revenue phase. You have product ready, you have a few customers who are already paying something. Banks are not giving you loans, but some investors might give you a combination. Yes, I give you a loan, but later on I want a little bit equity as well, some part of shares in your company as well. Grants, do you have grants here in Georgian place?
Yes, of course.
And available for startups to start products?
No.
Quite often.
Now an organization is starting to do like this.
Not really for
Not really for,
business, mostly for NGO projects.
okay.
Yeah, there is the most of them are from councils, but the ministries have already grants.
Okay. So how many of you would get a grant based on your business idea? Yeah. Grants is definitely a very good way to finance your company because you don't need to give away shares. And actually, this is quite important thing to understand. Giving away shares to investor is the most expensive financing ever. Paying loan interest 10%, 12%, 15% is always cheaper than giving away the potential upside. Part of your business, when in terms of when the company is getting successful, you might have profits, you pay out dividends. There is high probability that dividends pay always more, or at the time of exit, investors get always more than you would get from loan interest 10 to 15%. So try to get as much as possible all kind of different financing before really giving away part of your company. Actually, one smart way, which is not used too much, is to finance your company through customers. And if you have strong product, in some cases, it is possible to ask customers for prepayments or partnership payments as well. For example, we have one company in our portfolio which has very strong IP, very strong product, and one of the Chinese customer is thinking about the product is not ready yet, but it can be tested. And one of the Chinese customers is willing to pay $6 million prepayment for the product that he hopes to get after a couple of years, and getting exclusivity for Chinese market as well. So customers, if to structure smartly, might be also a very good source of financing your business. For example, you might try to sell get the prepayment for some of the ebooks in science area from libraries or from ministries or universities. You say, we will translate this book, and we have done it like 10 times before. Please prepay. We deliver in 4 months, and the prepayment can finance your company for very clearly for some period of time. But the reality comes down to always to the family. Dad, please be nice and give me some money. So in reality, it is called FFF, Friends, Fools, Family money, who probably would trust you, give you first money, family, friends, angel investors, and so on. It is not a good idea to take fool's money still. So on financial statements, you probably need to produce 3 different items. Income statement, you know what it is. Revenue, cost, profit. Balance sheet, which is a bit more complicated, about your assets, how many assets you have, how many loans you have, what is the equity, and so on. But in early days, the absolute most important thing is cash flow. And cash is king, but if you project it in a wrong way, it might become destroying King Kong in your business. So how much cash you actually have in your company? And this is what we require, for example, from our portfolio companies monthly basis. In what months, how much money comes in from customer, from investments, from grants, from partnerships, whatsoever, and exactly how much money goes out. And this is purely cash based. If I write invoice, if I send out invoice today and the money arrives 60 days later, then in cash flow I take it into account 60 days later, right? So when exactly the money is coming. And this is a way how you project your break-even point when you have enough money to run the company independently, or how you source the cap on the way. One thing about margins. I mentioned before as well, and I'm not sure if it's too complicated or not, but you have definitely learned maths as well. So here is again an example of the company. On the first revenue, on the first year, it has 100,000 euros revenue. Last year it's more than 800. The cost of sales increasing. So it might be more advertising, it might be more logistics, whatsoever. But what is attractive over here? That the gross profit is increasing over time. So the first two items, revenue and cost of sales, are critical to take a look at, and particularly the cost of sales. So and gross profit comes and what is cost related to your product and how much money you can make out of it. There are business areas where the cost is very high and you cannot add much as margin to the customer price. For example, wholesale business. We have one company in our portfolio which sells online all IT goods. Just reseller. Getting wholesalers, I don't know, iPads, keyboards, and so on. The company is doing about 42 million euros revenue. That's quite a lot, right? But unfortunately, they buy all the IT goods and so on. And the gross profit margin is only about 7 to 10%, which means they do 42 million euros revenue and have close to zero profit. Right. So the gross profit shows pretty much what is the value of the product and what is the value add you really can bring to the table. And usually investors would look at startups where the gross profit tends to be 50% plus. It means that the market is attractive. It means that the competition is not extremely high. It means that there is higher potential to gain some market share. And then you have general cost, R&D. Over here it's, was it 10% or 2% from revenues, 1% from revenue. Sales, marketing, administration, all your salaries, rental costs, everything related to your business. Then you have taxes, amortization, whatsoever, and the net profit and net profit margin. So these both of the margins, investors will take a care look. We probably will not model today your businesses in such a precise way. But if you happen to develop income statements, balance sheets, take a look at the gross profit figures and try to figure out if it's possible to have at least 40-50% of gross margin in your business.
What does EBITDA?
Yes, thank you for asking.
And why is there no zero in the second year?
Actually, accidentally, it's a good year. It's break even. It's earnings before interest and taxes. Basically, you take all the earnings and cost, and after EBITDA comes taxes, depreciation if you have põhivara. Kuidas põhivara on? Fixed assets. You need to amortize over time. For example, your roasting machine. You will buy it maybe for 100,000 euros or 10,000 euros, and you will amortize it over years. So EBITDA means earnings before interest, taxes, depreciation, and amortization. Okay. And a couple of final words. We probably will, Elmo, What do you think? We will try to figure out the first year cost base, for example.
Yes, I think that will be very good.
Yeah.
At least the cost of the start
Yeah,
somehow.
yeah,
And this will be
yeah.
this will be very good.
Before we do it, just final items. The finances, you do it for yourself. And it is the best is to do it yourself. Actually, quite often you could see that startups come to the meeting and you start discussing finances and someone else has made them. So founders don't really understand what is written down. So it needs to be really made by you. Secondly, add buffer to numbers. For example, if we start to estimate what is the cost to start your business, usually you come down to very optimistic figures, but definitely add 30 or 50% on top of it. Rebudget. In very early phase, when you start business, the first revenue comes along. For example, we ask companies to rebudget sometimes monthly, sometimes quarterly basis. So you don't estimate the future correctly. And whenever you have facts in place, you always rebudget the future again. For example, one ebook was late, 2 months, the revenue didn't come along, you rebudget the whole thing. And try to be happy at the same time. Okay. Yeah, keep smiling at the same time. Okay, thanks.